Stock market terminology deep dive for beginners. Understanding the language of the stock market is like learning the grammar of a new language. It's the foundation for everything else. Let's begin with the most fundamental term, stock. A stock, also known as a share or equity, represents a unit of ownership in a company. When you buy a stock, you're purchasing a small piece of that business. If the company grows and becomes more profitable, the value of your share typically increases. Conversely, if the company struggles, your share value may decline. Stocks are traded on public exchanges such as the New York Stock Exchange, NYSE, or NASDAQ, which act as centralized marketplaces for buyers and sellers. Next, let's talk about dividends. Dividends are payments made by a company to its shareholders, usually from profits. They're typically distributed quarterly and can be in the form of cash or additional shares. Not all companies pay dividends. Many growth-oriented firms reinvest their earnings to fuel expansion. However, dividend-paying companies are often seen as stable and mature, making them attractive to income-focused investors. For example, blue-chip companies like Johnson & Johnson or Coca-Cola have long histories of consistent dividend payments. Market capitalization, or market cap, is a measure of a company's total value in the stock market. It's calculated by multiplying the current share price by the total number of outstanding shares. Market cap helps investors categorize companies into large cap, typically over $10 billion, mid cap, $2 to $10 billion, and small cap, under $2 billion. Large cap companies tend to be more stable and less volatile, while small cap stocks may offer higher growth potential but come with increased risk. Understanding market cap is essential when building a diversified portfolio. The terms bull market and bear market describe the overall direction of the stock market. A bull market is characterized by rising prices, investor optimism, and strong economic indicators. It often reflects a period of economic expansion and increased consumer confidence. In contrast, a bear market occurs when prices fall by 20% or more from recent highs, usually accompanied by economic slowdown and pessimism. These terms are metaphorical. Bulls charge upward with their horns, while bears swipe downward with their paws, and they help investors quickly describe market sentiment. Volatility refers to the degree of variation in a stock's price over time. High volatility means a stock's price fluctuates significantly, which can present both opportunities and risks. For example, tech startups may experience rapid price swings due to news, earnings reports, or market speculation. Low volatility stocks, such as utility companies, tend to have more stable price movements. Volatility is often measured using statistical tools like standard deviation or the VIX index, which tracks market-wide volatility. A portfolio is the collection of financial assets you own, including stocks, bonds, mutual funds, ETFs, and other investments. A well-constructed portfolio reflects your financial goals, risk tolerance, and investment horizon. Diversification, spreading your investments across different sectors, industries, and asset classes, is a key strategy to reduce risk. For example, owning stocks in both technology and healthcare can help cushion your portfolio if one sector underperforms. To buy and sell stocks, you'll need a broker. A broker is either a person or a digital platform that facilitates trades between buyers and sellers. Today, most investors use online brokerage platforms like Fidelity, Robinhood, Charles Schwab, or E*TRADE. These platforms offer tools for research, analysis, and execution of trades, often with low or no commission fees. Some brokers also offer educational resources, retirement accounts, and automated investing through robo-advisors. Liquidity is a measure of how easily an asset can be bought or sold in the market without affecting its price. Highly liquid stocks, such as those of large companies, are traded frequently and can be sold quickly at market value. Illiquid stocks, often from smaller or less-known companies, may be harder to sell and could require accepting a lower price. Liquidity is important when considering how quickly you can access your money in case of emergencies or market downturns. The price-to-earnings ratio, PE ratio, is a key valuation metric that compares a company's current share price to its earnings per share, EPS. It helps investors assess whether a stock is overvalued or undervalued relative to its earnings. A high PE ratio may indicate that investors expect high future growth, while a low PE could suggest the stock is undervalued or facing challenges. For example, tech companies often have high PE ratios due to anticipated innovation and expansion, whereas mature industries like manufacturing may have lower PE ratios. Earnings per share, EPS, is another important metric. It represents the portion of a company's profit allocated to each outstanding share. EPS is used to gauge a company's profitability and is often reported quarterly. Rising EPS over time is generally a positive sign, indicating that the company is growing and generating more profit for shareholders. Bid and ask prices are terms you'll encounter when placing trades. The bid is the highest price a buyer is willing to pay for a stock, while the ask is the lowest price a seller is willing to accept. The difference between the two is called the spread, and it reflects the liquidity and volatility of the stock. Narrow spreads typically indicate high liquidity, while wide spreads may suggest lower trading volume or higher uncertainty. Limit order and market order are two common types of trade instructions. A market order executes immediately at the current market price, while a limit order sets a specific price at which you're willing to buy or sell. Limit orders give you more control over the price but may not execute if the market doesn't reach your target. Understanding these order types helps you manage risk and avoid unexpected outcomes. Diversification and risk tolerance are foundational principles in investing. Diversification means spreading your investments across different assets to reduce exposure to any single risk. For example, owning stocks, bonds, and real estate can protect your portfolio from sector-specific downturns. Risk tolerance refers to your ability and willingness to endure losses in pursuit of gains. It's influenced by factors like age, income, financial goals, and personality. Younger investors may have higher risk tolerance and favor growth stocks, while older investors might prefer income-generating assets like dividend stocks or bonds. Lastly, index funds and ETFs, exchange-traded funds, are popular investment vehicles for beginners. An index fund tracks a specific market index, such as the S&P 500, and offers broad market exposure with low fees. ETFs are similar but trade like stocks on an exchange. Both provide instant diversification and are ideal for passive investors who want to minimize risk and avoid picking individual stocks.